Alright, so day trading is kind of hard and ICT concepts are hard too. So I'm going to make it brain rot version so you guys could understand it. Last video I talked about liquidity sweeps and here it is. This is an example of a liquidity sweep that was actually executed. So now we're going to be talking about fair value gaps. So a fair value gap, let's draw it over here, is when 3 consecutive candles don't align. Actually, fuck it. That's going to take too long and you're too stupid to pay attention. So let's use an example right here. So this is a fair value gap. This right here is a fair value gap. Do you see how it's 3 consecutive candles, 1, 2, and 3, and the wicks, the bottom wick and the top wick don't touch. This is a bearish fair value gap. See, another example right here. This is a fair value gap, right? Do you see that fair value gap? This, I have it drawn out already. That is a fair value gap, right? This is a fair value gap from here to here. I don't know why I drew that weird. From here to there, right? So this is a live trade I actually took. I dropped this in my Discord. This was kind of a while ago. Yeah, this was in Wednesday. Right now, I believe it's Sunday. Yeah, it is Sunday. So let me explain why fair value gaps work. So imagine you're taking a poop, right? You're taking a poop in a skibidi toilet poop. Okay, you're skibidi toilet. You're taking a poop, right? And you flushed the toilet. You took a massive shit, all right? So like the shit was crazy. It like spiraled in circles, kind of like the emoji, right? It was a big poop on this guy's head, and you flushed the toilet. Most likely, the whole poop will not get flushed down, right? So you're gonna have to flush it again, and maybe again. You might have to flush it 3 times. That is because there's a lot of resting order in the poop. Right, so we can imagine it as in the stock market. This, here, wait, let me make that. Okay, that's so much better. We're gonna imagine it here. This fair value gap, or this one, because this one got touched in. Sorry guys, I'm a little sick. But yeah, we see this fair value gap right here. This is your big poop that you took. You took such a big poop that you have a lot of gaps in the market, right? There's a lot of gaps in the market now because of the big move down. And you can see through these wicks. So because there's no wicks at all, that means there was no orders made there, right? Price just fully sold off in that one specific moment. So because of this, the market makers, or like the banks and institutions, the algorithms, whatever, they want to go back to retrace into that fair value gap. So there's a gap. They want to create fair value by retracing back into it. And then now they took out a bunch of orders, right? So there's some people that had orders left in here. They took out some of the orders. It's kind of like flushing the toilet again. They went back in to flush the toilet, and now it's going to continue its move down, right? You can see the same thing over here. Made a fair value gap. It retraced back into it by a tiny bit, and then it flushed down, right? So that's literally fair value gaps. This is the simplest terms I can explain fair value gaps to. But because I want to teach you guys sauce without having you guys to pay, the only thing I want in return is to subscribe. But I want to show you guys a lot more because fair values could get really deep, right? It could get really complex. One thing I want to state though is don't look at fair value gaps to predict the market. You can never predict the market. People that say that they're able to predict the market are just gamblers. They don't know what they're talking about. The only thing you could do is observe the market. So we can wait for a fair value gap to be inversed, for example. We can wait for it to be touched into a trigger zone, which I'll explain right now in this video. So let's talk about inverse fair value gaps first. By the way, somebody would have fucking charged you a lot of money for this knowledge. So some fair value gaps, like this one right here. Here, I have it drawn out as purple because it's a BPR. I'll show you guys what it means later. But here, I'll delete it for now. This fair value gap. Yeah, let's make it red because it's inverse. Oh, oops. There we go. So this fair value gap went into it. So price went into the fair value gap and it closed below it, right? So if we look at this example, price went in and it touched into it, right? And it went down. However, in this case, it closed below it and it inversed it. I consider for me in my strategies, I consider inverse fair value gap to be when price closes below the box. So sometimes you might see something like this, right? So let's say this is a candle All right, so this might take like a kind of a while. So this is a candle. Okay, whatever, blah 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 blah. And let's see, this was a fair value gap right here, right? It's a bearish fair value gap. I mean a bullish fair value gap. We're going up. So this is the gap. Sometimes price might come down and it wick below it, but it doesn't close, right? Let's say this is like the closing gap. So it wicks below it. Here's its wick. It wicks below it, but it doesn't close below it. That is not a close. People say that is. For me, what I've noticed from looking at the markets, that is not a close. So what I consider a close is when it, what I consider inverse is when it closes below it. Wait, what the heck was I saying? That is not an inverse. I consider inverse when there's a close, right? So we can see it over here. This is a fair value up originally. Boom, see? And then price, it touches into it and it closes below the gap. This is now an inverse fair value gap. This in itself has another function. So sometimes price, like in this case, this is a perfect example, that's why I picked it. In this case, it inversed it, it came back in, boom, and it touched into the inverse and it retraced off, right? So that shows that like you can catch moves off that, right? You can catch moves off the inverse fair value gaps as well as the fair value gaps. But in this case, this is why it was purple. This is why I had it as purple, is because it's what I call a BPR, right? So what is a BPR? It's when an inverse fair value gap and a regular fair value gap intertwine. So here, this is the inverse one, and this is the regular one, right? This is the regular fair value gap. Do you see how they overlap? The overlap is what I call the BPR, or not what I call, what ICT calls the BPR. It just makes like a stronger confluence, so you can have more confidence to see that price will go into it and then retrace down, right? Oh, this is a lot of information in one video. I hope you guys are taking notes. Now let's move on to the trigger zones, right? I mentioned this in my past video. Somebody in the comment section said that they wanted a video about it, or they wanted me to explain it. So trigger zones. Price is very like it's algorithmic, right? So if we take our Fibonacci sequence, and then I have it as the FVG mode here. The bottom half of the fair value gap is where price usually touches into and then reverses off. So just this area right here, this, I could draw a box right there. This box right here is the trigger point or trigger zone or whatever, right? It touches into it and it reverses off it. So that it just shows a higher probability that the fair value gap will be respected. These zones are also key levels. So if you have 0.25, 0.5, 0.75, these are all key levels. So what happens is price usually touches into it or goes a bit above it and then boom, zips down, right? Wait, I just want to try something out. I'm just curious if the BPR thing works. So yeah, you could also do it on the BPR. See, the BPR, it touched into the 0.5 section, the trigger zone, and just by a tiny bit went over it and then zipped down, right? We could look at it over here too. So this obviously was in the half zone, right? This obviously was in the half zone. It touched into the bottom half of the fair value gap and went down. This also works for upwards trend. So if it's a bullish, this is a bearish fair value gap because it's going down. But if it was a bullish fair value gap and it was like going up, like see, this is a bullish fair value gap example. But it got inversed, right? But here, let's look at it right here. You see how price kind of touched into it on the half zone, right? See 0.25, it touched into it, kind of moved up, and then most likely there was some like order block or whatever it touched back into, and then moved down, inverse the fair value gap, touched into the BPR, moved past that, inverse this, right? All these confluences are starting to add up. At first it's gonna be kind of hard to see this, hard to notice this, hard to be like spot on with it, right? So you can, if you're unable to spot fair value gaps, just go over here, Lux Algo, or Nephew. I use Nephew Sam, FVG. It just marks it all out for you, right? Here it might not mark out because this is from a while ago, but it marks out the present ones. That's okay. That's for how you can see it. For how you can understand how it works, just probably watch this video multiple times. If you don't understand it from me, you can watch it from someone else. Right? Oh, I forgot to use these characters. Wait. All right. So Thomas the Train. Okay. This is another thing that could happen, and I'll use Thomas the Train for this. So sometimes we have a candle, and then within the fair, before the fair value gap happens, here, let me draw it out. Okay, you guys have to have some attention for now, just for now. Right, so this. Let's say it made a fair value gap. These are candles, by the way. So let's say it made a fair value gap. Most of you will be inclined to think that this is the fair value gap. But what happens sometimes is Thomas the Train or the market makers, they put in a lot of orders really quickly, and then there's a volume imbalance, right? So sometimes on your chart, you'll see that there's like a little gap, right, between the candles. So here there's a candle. See how they're all right beside each other? Sometimes it could leave a tiny gap. That is not a glitch, right? I mean, sometimes the broker or whatever you're using the chart at, it could mess it up for you, but that's just the volume imbalance. It's you can mark it out as VI, and what that means is that this fair value gap is not correct. What you would have to do to take account into Thomas the Train's fucking bulldozing or like training through the volume is we have to move the fair value gap down to the gap, right? So not a lot of, again, unless you heard this from ICT, nobody else would say this. Like, you wouldn't learn this other than me. But here, instead of doing it from the wick to the wick as we did previously, you do the wick to the end of the gap, like to the open of the, to the close of the candle, previous candle. See, that's how you take account to volume imbalances. And yeah, that's all I really have in my mind right now. There's probably a lot more that I'm just forgetting to state. But yeah, I hope you guys enjoyed this video. If you guys did, consider subscribing. Just comment down if you like this type of content. I will upload more, right? Also, make sure you subscribe. It's completely free. John Pork is telling you to subscribe. Yeah, and also I have a free Discord. Wait, let me zoom in on my face so you can see the intensity in my eyes. I have a free Discord community, link in description. Basically, you could ask questions. I might not be able to answer all of them, but there's a lot of profitable traders there that you could talk to, learn from, make money from. Also, sometimes I drop my trades into the chat as like a way to keep myself accountable, because some people, they're gonna be like, oh, you're just a scammer, you don't know how to trade. So every now and then I drop a trade into the chat. I'll be like, guys, this is what I think is gonna happen. If it wins, if it loses, I just keep you guys posted. Yeah, I guess that's all. Subscribe. My Vaseline. Subscribe, leave a like, and comment for the algorithm. Bye.